markets began the new year with a shaky start, with major stock indices ending down for the week. The concern for investors was inflation and the possibility of rising interest rates. These worries were stoked by the recent Fed minutes, which discussed plans to reduce the Fed balance sheet. Growth stocks have been affected more than the S&P 500 since these stocks usually trade at higher valuations. But when considering the stock market in 2022, it may be helpful to think about what the market did last year, especially the last week of the year. So let's take a look. Since last year was a strong year, I often hear the markets are due for a decline. But let's take a look and see if this has historically been the case. This chart from LPL Research shows that greater than 25% up years are actually a good sign for the following year. Since 1950, the market has been favorable 86% of the time in the subsequent year, with an average return of about 12%. Now, you may have also heard of something called a Santa Claus rally. So why should we care about a Santa Claus rally in January? Because there is a hypothesis that what occurs in the last week of the year may indicate what may be ahead for the new year. December is statistically one of the best months of the year, but the gains usually occur in the last 2 weeks of the month. Perhaps for this reason, many people think of a stock rally in December as being a Santa Claus rally. And that's okay with me. But according to the technical definition, the term Santa Claus rally refers specifically to trading during the last 5 days of the year and the first 2 days of the new year. Statistically, this is a good time for the stock market. These 7 days trade higher more than any other 7-day block of the year, up an average of 80% of the time. The average return of 1.3% is also among the best of all 7-day periods. Why does the market often rally during this period? There's no way to know for sure. Possible factors include seasonal spending patterns, light trading as people are on vacation, holiday cheer, or perhaps my favorite, general optimism for the new year. This chart from LPL Research shows that the markets were often higher during these days. But interestingly, every time there was not a rally, January was lower. Taking a closer look at what happens if there is no Santa Claus rally, consider this chart that goes back to the mid-1990s. We see that 5 out of 6 times when there was no rally, the market was down for January, and the market had a solid gain for the year only once. In other words, a Santa Claus rally is a good sign for the markets, and the lack of one a bad sign. I'm happy to report that we had such a rally this year. From Bloomberg, Santa Claus delivered a late gift to investors, with the S&P 500 index posting its biggest gain during the so-called Santa Claus rally in 9 years, according to LPL Financial, potentially signaling a healthy 22 for U.S. stocks. If you've got questions on the market in the new year, please give us a call or visit us online at chambersfinancialgroup.com. We're not in it for the short term, we're in it for the country mile.